Breaking news straight to the White House. President Trump delivering remarks on that new $100 billion investment from chip makers. Let's listen in.
Welcoming from TSMC.
Huawei is planning to begin mass shipments of its new AI chip to China as early as next month.
Imagine a world where the United States rules meant to slow a rival simply bounce off like pebbles on steel. The flood of new chip factories in China is surging past barriers, even as trade wars rage. Mega funds, relentless state backing, and homegrown design breakthroughs have lit a fuse under an industry once thought out of reach. What if the very sanctions meant to protect American tech only fueled a rival's rise? Just how did China manage to pull this off, outspending rivals and rewriting the rules of the game? We will be answering these and many more questions, so stick around because the journey is about to begin. Boom time, China's semiconductor surge. In 2024, China invested about $50 billion in machines and tools for making chips.
From a breakthrough in chip-making technology to its stronghold on the rare earths market, the West is really struggling to catch up with China's critical might.
This amount is more than double what South Korea or Taiwan each spent. The industry group SEMI notes that global spending rose only slightly, while China grew by almost 20%. In 2025, the same group expects China to spend $38 billion on new equipment, even after a planned drop. These big numbers show how Beijing uses cash to back factories and design houses. Local companies are lining up orders for the latest machines that make both memory and logic chips. This flood of money has pushed China ahead of every other region in its raw ability to build chips. In May of 2024, China launched its third state investment fund for semiconductors. The fund holds nearly $47.5 billion. That follows two earlier funds that raised about $70 billion combined. The new pool is run by the China Integrated Circuit Industry Investment Fund and includes money from the Finance Ministry and China Development Bank. It aims to help firms buy new machines and build plants. Shanghai also pledged about 100 billion yuan, or $13.8 billion, to boost local chip, artificial intelligence, and software projects. The scale of these funds shows how state backing drives each innovation step. Semiconductor Manufacturing International Corporation, or SMIC, is China's largest chip contract maker. In the fourth quarter of 2024, the firm reported revenue of $2.2 billion. That was a growth of over 31% from the year before. Investors expect more gains, but profit margins remain thin. Semiconductor Manufacturing International Corporation has spent more than $7 billion on new tools and plants since 2021. The firm is focused on so-called mature nodes, like 28 nanometers, which serve phones and cars. By ramping up these lines, Semiconductor Manufacturing International Corporation has gained new market share from rivals in Taiwan. The company is still waiting to match the most advanced nodes overseas. Yangtze Memory Technologies, or YMTC,
Yangtze Memory Technology's 64-layer flash memory chips have the highest density of memory arrays among their peers,
is the leader in homegrown memory chips. The firm began work in 2016 in Wuhan with help from state funds. In April 2024, Yangtze Memory Technologies said it had built a 128-layer flash memory chip. That chip can store more data than earlier designs. The firm now uses its in-house tools in many production steps. It has won awards for its X-stacking approach to stacking layers of cells. Some yield issues arose at first, but engineers have raised success rates well above 30%. Yangtze Memory Technologies now sells to Chinese customers who need large and fast storage. Huawei has its chip unit called HiSilicon. It shifted to Semiconductor Manufacturing International Corporation's 7-nanometer process for parts of its phone and server chips. This shift took years of redesign work, but helped avoid the United States limits. A newer player, Biren Technology, built its BR100 GPU to sit just below export thresholds. That move lets Biren ship chips without full United States approval. More startups like Black Sesame and Horizon Robotics are also making custom AI chips. They aim to power smart cameras and self-driving cars in China. These firms show how local design is closing the gap on big global names. Several smaller foundries have also benefited in China. Firms such as Nextchip and Hua Hong Semiconductor focus on older chip types at 28 nanometers and above. They sell these parts at lower prices than many overseas rivals. That model has helped them win orders for screens, electric vehicles, and household gadgets. Price cuts of up to 30% have drawn customers away from Taiwan and South Korea. This drive to serve mature priorities has given China a broad base of capacity. It also frees high-end lines for parts that need more extreme precision and small size. China has also built a full supply chain for chips. Homemade toolmakers like Nora and Advanced Microfabrication Equipment, or AMEC, now sell etchers and polishers for wafer lines. Local firms supply photoresists, wafers, and test gear. This work reduces reliance on foreign equipment and parts. Some global vendors, such as ASML, still lead in extreme ultraviolet tools. Yet China is close to matching them at legacy and mid-tier levels. Combined with more in-house chip design, these gains have made the industry more complete and less vulnerable. Investors watch how fast these firms move to 5-nanometer nodes. They trail top leaders and plan to close the gap by 2027. Many new fabs are underway in Chengdu, Shenzhen, and Xi'an. This push shows no sign of slowing as China backs homegrown chips. But while China builds up its chip empire, how is the US fighting back? Walls and barriers. United States sanctions unpacked. The United States first moved to limit China's access to key chips in October 2022.
China continues to dominate critical industries, despite continued efforts by the US.
On October the 7th, the Commerce Department's Bureau of Industry and Security issued a rule on advanced computing and semiconductor manufacturing equipment. This rule aimed to block China from obtaining high-performance processors and the machines that make them. It covered chips above certain speed or core thresholds and tools using extreme ultraviolet light. Companies exporting those items to China must now obtain special licenses and face penalties for violations. In July 2024, the United States announced another rule to control the flow of semiconductor equipment to China. This rule targeted the export of key chip-making machines, such as etchers, deposition tools, and wafer polishers from major suppliers. Countries like Japan, the Netherlands, and South Korea received narrow exemptions to protect essential industries. Most other governments and companies were instructed to halt shipments of those machines to Chinese fabs. The policy cut off the supply of vital gear for advanced node production. By December 2024, the United States had rolled out its third major export crackdown in 3 years. The package added 140 Chinese enterprises, including toolmakers and research centers, to the entity list. It also included high-bandwidth memory chips as restricted items. Companies dealing with any entity on that list must gain United States approval before sharing technology or components. These steps showed a clear intent to slow both older and cutting-edge chip production in China. The most dramatic action came in mid-April 2025. United States regulators declared that Nvidia's H20 AI chip and AMD's MI308 model would require export licenses for all shipments to China. Reports said the requirement would amount to a ban for most customers. Nvidia then warned investors it would record a $5.5 billion charge to cover undeliverable orders. AMD also flagged an $800 million hit tied to unsold inventory and reserved commitments. Trade allies in Europe and Asia have backed the United States measures, sharing some data on new Chinese industrial chip efforts.
China has announced a significant advancement in its semiconductor technology.
This global cooperation helps close loopholes and gives export controls a wider reach. The United States also uses tariffs to pressure China's chip trade. Section 301 tariffs of up to 50% on legacy semiconductors raise costs and discourage imports. Combined with export controls, These measures make older chips pricier and harder for Chinese firms to buy. Higher prices force companies to rethink their plans and shift toward local sourcing or less advanced parts. Many companies got very little warning before the April change. Sources said Nvidia did not inform its top Chinese clients until regulators made the rule public. Major cloud operators in China had expected chip deliveries by year-end. They learned of the license requirement only after the announcement. The surprise drove Nvidia's shares down over 6% in one session and sent other chip stocks lower. The Bureau of Industry and Security reviews license requests case by case. Officials can delay or deny permission if they see threats to national security. This review process gives regulators the power to block shipments one order at a time. It also forces companies to plan around uncertain lead times when serving Chinese customers. Intel joined the list soon after. The firm told clients that some of its advanced AI processors would now need export permission. Chips with high memory bandwidth or input-output rates fall under the new rules. This step showed regulators wanted to cover the full range of artificial intelligence hardware used in data centers and supercomputers. Toolmakers felt the squeeze too. Suppliers like Lam Research said orders from China were strong, but warned that future volumes could fall if rules tightened. ASML of the Netherlands noted that new tariffs and export curbs clouded its outlook for 2025 and 2026. Some Japanese and Dutch firms won small exceptions, but still saw customers delay orders. These layered controls are a clear use of trade policy for national security. Each action built on the last, closing gaps and adding more products to the list. The result has been a barrier that cuts into China's plans for next-generation chips. Some observers worry these walls will push China to build its supply chain faster than before. With tighter rules, Chinese labs can still use older chips for artificial intelligence research. They add that these limits may slow progress, but are unlikely to stop researchers from finding workarounds or using alternative hardware for training models in depth and scale. Workarounds and wins. How Beijing fights back. Just as the walls rose high around China's chip ambitions, engineers and leaders found cracks to squeeze through. Local firms began to adapt their designs so that the United States rules would not apply. Biren Technology, a startup in Shanghai, became known for its BR100 graphics chip. After the 2022 export ban, Biren cut some data links on the chip, so it stayed just under the limit for high-performance devices. That tweak let the firm resume limited production at Taiwan Semiconductor Manufacturing Company. By late 2024, Biren had also secured a $280 million pledge from Guangzhou government-backed investors and was preparing for an IPO tutoring process. At roughly the same time, Huawei's chip unit, HiSilicon, finished a multi-year project to change its processor designs for SMIC's 7nm lines. The company had lost access to foreign foundries in 2019, but it invested heavily in in-house tools and software. In early 2025, Huawei was ready to ship its Ascend 910C AI chip to big internet firms. That chip pairs two earlier models into a single package, pushing total speed close to Nvidia's banned versions. Samples of the new parts have quietly reached data centers, even as official announcements awaited government approval. Other Chinese teams moved quickly to use older chips in fresh ways. Yangtze Memory Technologies rolled out new three-dimensional memory layers that boost data density on older nodes. A small group of artificial intelligence labs began training models on laptops and edge servers instead of giant data centers. These DIY clusters tapped local fabricators to build racks of mid-range GPUs, tied together by custom switches. They traded raw speed for lower cost and easier sourcing. More than half of new AI model training in China now uses clusters built with mid-tier GPUs, including a mix of Nvidia H800 and domestic BR100 models. Teams link the chips using custom interconnect boards made by Semiconductor Manufacturing International Corporation spin-offs. They rely on local software libraries, such as MindSpore and OneFlow, to run large language models and computer vision tasks. Some startups now advertise hybrid training services, combining both foreign and domestic chips under unified management. More Threads, another Beijing-based startup, followed Biren's lead. The firm trimmed memory bandwidth on its MTT100 GPU to fall under export ceilings and resumed limited runs at a local fab. That move was backed by a 200 million yuan grant from local authorities. More Threads now claims its MTT100 can serve low-end AI and auto systems at nearly half the cost of foreign parts. At the same time, Guangdong province set up a chip sandbox in Shenzhen. There, local fabs and design houses test new processors in a controlled zone that enjoys fewer restrictions on imports and exports. That zone has attracted more than a dozen young chip firms since 2023. It acts like a trial ground. If new rules hit Beijing, companies can shift more work to the sandbox. Experts say this shows how China is spreading risk and building resilience. On the research side, Tsinghua University's lab in Beijing began pilot work on a parallel chip grid that uses older memory modules and field-programmable gate arrays. That setup ran initial tests of generative artificial intelligence at a fraction of the normal cost. Students built training frameworks that could offload work across nodes, proving that raw artificial intelligence development need not rely solely on the fastest chips. By March 2025, Chinese internet giants such as Alibaba, Baidu, and Tencent all confirmed they had switched parts of their artificial intelligence workloads to domestic solutions. They still use some Nvidia gear where allowed, but local chips now handle tasks like voice assistants and image search in region-specific apps. That mix helps them avoid total reliance on United States providers. State media have highlighted many of these wins. Stories in China Daily and People's Daily praise homegrown engineers and institutions. While the United States sees bans as a way to slow China, Beijing spins them as proving grounds for self-reliance. The more walls erected, the more local teams learn to find new cracks. These workarounds are not just technical achievements, but also show how China is building a broad ecosystem for chips. Each small design twist or local trial adds strength to the network. While the United States may tighten rules further, Beijing's gains suggest that banning a chip often spawns a new local design. The sun may set on easy export freedom, but a new dawn of domestic innovation has begun. But what happens when the ripple effects hit home? Just as China surges ahead, US tech giants are feeling the sting, and none more than Nvidia. The heavy blow: Nvidia's $5.5 billion write-down. When the United States said in April that Nvidia's H20 AI chip and AMD's MI308 model would need export licenses for China, the news landed like a thunderclap. Nvidia quickly told investors it would take a $5.5 billion charge in its first quarter to cover orders it could no longer fill. AMD said it would face an $800 million hit for unsold stock. In one trading day, Nvidia's share price fell over 6%, wiping out over $160 billion in value. Nvidia's boss, Jensen Huang, flew to Beijing days later to stress that China remains very important to Nvidia. He said the firm hopes to continue working with Chinese customers despite the new rules. His surprise visit showed how worried Nvidia is that losing access to China's huge market could hurt its long-term sales. Other tech giants also felt the pinch. Shares of advanced micro devices slipped over 1%, while Broadcom slid nearly 4% on renewed concerns of tighter export controls. Micron Technology lost about 3.5% as investors braced for higher costs due to new tariffs. Server maker Supermicro saw its stock dip over 5%, given its close ties to Nvidia's chips. Even equipment maker ASML warned that fresh United States tariffs and curbs could cloud its outlook for 2025 and 2026. Global chip indexes also tumbled. The Philadelphia Semiconductor Index fell around 4%, its sharpest one-day drop in months. Overseas, Taiwan Semiconductor Manufacturing's shares dipped 15% from late March peaks, while Samsung Electronics slid 10%. SK Hynix saw its stock fall over 7% in the same period. The sell-off shows how far market confidence can fall when trade rules change. Cloud operators in China scrambled to adjust. Alibaba, Tencent, and ByteDance each had planned big orders of H20 chips for data centers by the end of the year. They now must seek permits or delay expansion projects. Some smaller artificial intelligence startups paused their growth plans, moving work to domestic chips where possible. The disruption hit software teams that had built projects around Nvidia's hardware. Each export request now goes through a strict review by the Bureau of Industry and Security. Officials can delay or deny licenses if they see national security risks. That process can add weeks or months to delivery times and drive up costs for both chipmakers and customers. Companies warn that planning new AI services in China now carries a high degree of uncertainty. To balance the loss in China, Nvidia announced plans to invest more in the United States factories and research labs. The firm pledged over $70 billion through the end of the decade to build new chip plants in America. That promise won praise from some United States lawmakers, but offers no relief for customers in Asia. Nvidia said it will also support cloud partners in Europe and the Middle East in using H20 chips in markets that are still open to them. Despite the shock, many analysts still see long-term demand for artificial intelligence chips as strong. They note that hyperscale cloud providers around the world will compete for the chips Nvidia can sell. Some expect tight supply to push up prices and spur firms to seek alternate suppliers from Japan, Europe, and even China. The move is seen as proof that the United States fears China's rise, praising domestic firms for filling gaps and calling the hit a bump on the road to self-reliance. Analysts at Wedbush warned that hardly any tech companies will issue earnings guidance in the near term, given the tangle of trade and economic uncertainties. Bank of America and Morgan Stanley noted that Nvidia's charge reflects low odds of new export licenses for advanced chips this quarter. At the same time, some United States lawmakers have begun pressing for a review of the export policy, suggesting that hurting United States chip makers may damage the economy without really stopping China. These debates over trade and security will likely shape the next steps, as companies and investors look for firmer direction on what parts can and cannot flow to China. When all is said and done, the charge may show up in 1/4 of the results, but the real test comes next year. If China builds its chips at scale, Nvidia and its peers could lose a vast slice of revenue. For now, though, the write-down stands as a stark marker of how geopolitics can change a tech leader's fortunes. Crisp ripples. Global markets react. As the dust settled on the write-down shock, global markets began to show ripples that reached far beyond chip makers themselves. Equipment companies like Lam Research delivered a surprise beat in late April, reporting quarterly revenue of $4.72 billion and adjusted profit of $1.04 per share. Over 30% of those sales came from China, a sign that demand there remains strong despite tighter export rules. Investors rewarded Lam's performance by pushing its shares up over 4% in extended trading, underlining market confidence in its equipment business. On the manufacturing front, Taiwan Semiconductor Manufacturing Company recorded a 57% jump in net profit for the first quarter of 2025, driven by surging demand for advanced processors used in artificial intelligence. The result translates to nearly $11 billion of profit in just 3 months. Yet TSMC's stock has slid more than 20% since the start of the year. The company has pledged over $100 billion for the United States plants, but most output will remain in Taiwan, leaving markets uneasy about its global exposure. Samsung Electronics has also felt the chill. Its shares are down around 10% since late March peaks, wiping out tens of billions in market value. South Korea's biggest tech firm said it would maintain capital spending, but warned that uneven trade ties and higher costs could weigh on margins. It also unveiled plans to boost investments in memory chip capacity to ride a hoped-for recovery in prices, a move aimed at offsetting weakness in its mobile and consumer divisions. Across the Atlantic, chip stocks have not been immune. The Philadelphia Semiconductor Index fell roughly 4% in the days after new export rules took effect, marking its sharpest run of losses in months. ASML, which supplies lithography tools to the most advanced fabs, expects that the United States and Dutch export curbs will cut its China sales by up to 15%, yet the company still forecasts solid overall growth. Its shares recovered some ground after executives said Chinese customers would continue to invest in mid-range tools for mature node production. With pressure from domestic exporters, Taiwan's government announced plans to set aside about $2.7 billion in aid for companies hit by United States tariffs. The package will cover steel, chemical, and electronics firms and offer loan subsidies and tax breaks. Officials also dispatched envoys to the United States to seek clarifications and, where possible, carve out exemptions for sensitive industries, such as semiconductors. In Europe, leaders like German Chancellor Olaf Scholz warned of the broader fallout. In a joint G7 statement, partners vowed to balance security concerns with the need to avoid fracturing the global economy. At the G20 spring meetings in Washington, Japanese Finance Minister Katsunobu Kato urged his counterparts to cooperate to stabilize markets and warned that the United States' tariffs and countermeasures from other nations were hurting growth and causing currency swings. He specifically called on China to address its excess chip production capacity to prevent supply gluts that could destabilize markets. Analysts warn that these market tremors could extend beyond the semiconductor sector. Credit conditions and bond yields have shifted as investors reassess the risk of a deeper technology slowdown. Some hedge funds are reportedly increasing stakes in chip equipment rental and leasing companies, betting that firms will prefer to hire older machines rather than risk further export shocks. Others note that rising Asian bond spreads hint at wider concerns about how trade wars might hit corporate debt and regional financial stability. Meanwhile, cloud providers and data center operators are weighing the cost of delayed AI projects. Some have paused expansion plans in Asia and are redirecting workloads to regions where supply is more certain. That shift could depress land prices and power demand near major Chinese and Taiwanese tech hubs, adding another layer of difficulty for local planners. Despite the turbulence, many investors still regard semiconductors as a long-term growth theme. They point to unmet global demand for computing power, the rise of generative AI, and new applications in automotive and healthcare. However, they also stress the need for diversified supply chains, more resilient logistics, and clearer rules of engagement between governments. As spring turns to summer, all eyes remain on the next wave of earnings reports and policy announcements. Will the United States and European allies broaden their export coalition? Can China keep its factories humming without key foreign tools? Could fresh subsidies or diplomatic deals soften the blow? The answers will shape not only chip stocks, but also the wider arc of global economic recovery. And just when you think the dust is settling, the next chapter looms, one filled with high-stakes decisions, policy pivots, and a tech standoff that's far from over. So, what comes next? With the semiconductor saga unfolding at high speed, a host of unanswered questions now hover over the global tech landscape. First, will America push its export rules even further? Some officials have hinted at new restrictions on networking gear, memory devices, or tool sets that touch advanced nodes. If that happens, Chinese chipmakers may race even harder toward full self-reliance, raising the stakes for an arms race in industrial policy. Could China's pivot to Malaysia, Vietnam, or other Southeast Asian hubs outflank the United States curbs? By shifting final packaging and assembly to friendly jurisdictions, Chinese firms may be able to blend local and foreign content in ways that muddy export rules. Observers are already watching special economic zones set up in Kuala Lumpur and Ho Chi Minh City, where tighter local controls apply But United States sanctions might not. What about talent? Beijing may accelerate visa and grant programs to lure chip engineers from overseas, hoping to transfer know-how faster. At the same time, academic and corporate labs may diverge in their hardware choices, with United States and European facilities doubling down on bleeding-edge accelerators, while Chinese teams optimize software for mid-tier chips. Another puzzle concerns Taiwan's role. With TSMC at the heart of the global supply chain, will Taipei seek fresh security guarantees or deepen its support to keep fabs running at full tilt? The recent pledge of $2.7 billion in subsidies for tariff-hit firms suggests authorities are bracing for more friction. Yet, questions remain about how those funds will be allocated as tech priorities evolve. What might this mean for leading chip designers? Nvidia, AMD, and Intel face an uncertain map of allowed customers. Will they step up efforts to diversify in India, the Middle East, and Africa? Reports suggest some artificial intelligence startups in Dubai and Bangalore are already in talks to host GPU clusters for global clients, offering a potential alternative to Chinese data centers. How will downstream industries react? Automakers in Germany and the United States need chips for electric vehicles and driver assistance systems. Will they stockpile semiconductors or invest in in-house design and local fabs? Rumors of partnerships between car makers and domestic chip makers in China and Europe hint at moves toward vertical integration. Meanwhile, suppliers of chemicals and photoresists in Europe and Japan may seek to build backup plants in North America, spreading risk but raising costs. Financial markets, too, face uncertainty. Will bond traders demand higher yields from chip equipment firms? Are fund managers prepared for a multi-year adjustment cycle if self-reliance takes years to bear fruit? The sharp swings in Asian bond spreads and the shift toward leasing older tools suggest some investors are already planning for a slower growth scenario. Finally, a deeper strategic question persists. Can the world avoid a full tech decoupling? Both sides claim they want secure supply chains, but the more each side locks down its ecosystem, the harder it will be to rebuild bridges. Is there room for a middle path of structured trust zones, where companies and governments agree on shared standards? Or will chips become yet another realm of geopolitical rivalry, spurring a carve-up of global technology into competing blocks? These questions lack simple answers, and each new policy move or earnings report may tilt the balance. One thing is certain: the race for semiconductor supremacy has entered a new phase, and the next moves will shape the future of tech, trade, and national security. That wraps up our look at how China's chip surge has outpaced the United States' sanctions, forced Nvidia's huge write-down, and sent tremors through global markets. The battle over semiconductors is far from over, and twists emerge every week. Thanks for watching. Please don't forget to like and subscribe.